Google stock, Alphabet, will report earnings in a few days on April 25. So in this video, we will analyze two unusual trades by wealthy investors so we can trade in the same direction as the rich, bullish or bearish, and share how we set up our earnings trade, which happens to be risk-free. No loss even if we're wrong. And it can still profit if we're right. Sounds unfair, right? But it's possible. We know because we actually just did this for Netflix earnings. Netflix was actually one of our membership trades, so that's why we did not discuss our earnings trade publicly. We got into this trade early on in March and took profits early on in April. In fact, that was on April 3rd when we updated our trade for members only to manage our Netflix trade. And what we did on April 3rd was readjusted our trade to essentially turn it into a risk-free earnings trade, where even if Netflix crashed, which it did, we had no loss. So that's what we will be doing with our Google trade based on the data of unusual options activity. If you are interested in our membership trades, such as what we did with Netflix, make sure to go to our website. This video, when we manage trades, was only available for our gold level members. We'll put a link to our website at the top here. Check it out if you're interested to gain access to the trades of wealthy investors and also how we use options to reduce risk in order to increase profits. So without further ado, let's get into the data for Google and show how we are trading Google risk-free. So on the last trading day, you can see here, April 19, there were 3,100 contracts being traded by one wealthy investor. The second wealthy investor is over here, 2,200 contracts. Okay, these are two separate investors because you can see the time that they traded at was different. Okay, and they're trading different options as well. All right, so we'll take a look at the first one, the larger one at 3,100. This trade over here is not so significant where they are just selling puts. Okay, that is a mildly bullish trade. It does not tell us that something is very bearish or very bullish. Those are the types of signals we want to look for and not get distracted by the noise. Okay, this is noise. This does not help us. So we want to filter those out and look for the ones that actually make a difference. All right, so January 2026, we can see these 160 strike puts over here, volume 3,102, greater than the open interest. So we know these are opening trades. And when we go to the calls at the 240 strike, we can also see these 3,100 clearly opening because that is greater than the open interest. So we believe they are buying the 240 strike calls to open and selling the 160 strike puts to open. And so when we analyze this trade, you can see here that this is a bullish long trade because it has a positive delta. If it was a bearish short, it would be a negative delta. And we can also tell by this diagram here, it is sloping upwards. Okay, So as the share price goes up here on the x-axis, the profit lines go up. Okay, so that's also a quick way to tell that this is a bullish long trade. Okay, and what's very special about this trade, because they sold the 160 strike puts, essentially saying they're willing to own 100 shares of Google at this strike price. Each trade required $16,000 of buying power. And since they did 3,100 contracts, this trade required $49.6 million. Definitely a wealthy investor. Okay? So that's how we know that the rich are trading this bullish. Now let's take a look at the second trade to see if it is also bullish. Because if it is, then we have greater confidence that we should trade Google bullish for earnings. If it is bearish, then we will have to wait for more data to come in to make a more informed decision. Okay, so the second one over here expires sooner, May 3rd, 2,200 contracts. Okay, 140 strike puts, 162.5 strike calls. So let's take a look. May 3rd, we have the 140 strike puts over here. We can see these are opening trades since the 2,000 contracts are greater than the open interest. And for the 162.5 strike calls, the 2,000 contracts are also greater than the open interest of 793. So these are also opening trades. And for this trade, we believe they are also buying the 162.5 strike calls to open and selling the 140 strike puts to open. And so when we analyze this trade, this is also a bullish long trade that has a positive delta. And for this trade, because they sold the 140 strike puts, saying they're willing to own 100 shares at the strike price, each trade required $14,000 of buying power. They did 2,200 contracts. So this trade was $30.8 million. So now that we have two unusual trades by wealthy investors that are going bullish long, we also want to set up an earnings trade that is going bullish long. So how do we do that? This is what we did. For the same May 3rd options, you can see our positions over here at these three strike prices. And at the 165 strike calls, for each of our trades, we sold two, and then we bought the 167.5 strike call and the 160 strike call. And so when we analyze this trade, you can see this is a butterfly trade, and these are the ratios for each of our trades, a 1 to 2 to 1. Okay. Now, notice here that the debit here says 185. And so this is where the secret is. Okay. To make this an earnings trade that is risk-free, the key thing is that we need to start trading before earnings, make a profit first, then use a portion of that profit to trade earnings with options, so you know exactly how much you're risking. Because if you trade options correctly, you can define your risk. And that's one of the advantages of trading options. And so if you've been following our channel, you know that 2 months ago, we started to trade Google. Okay. And that was on February 27. And on the last trading day, April 19, those options expired where we made 200% profit. Okay. specifically $692 of profit. So we'll put a link to this video at the top if you missed it. But essentially, we're taking that $692 of profit on this trade that we had done, which was right over here for this one here that expired April 19th, these 140 and 150 strike vertical call spread that were deep in the money. Okay. And so we're taking the portion of this profit, the 692 that we made for each of those trades, and using it to trade earnings. Okay, so the $692 of profit, we subtract the debit on this new trade for earnings, 185. So we are left with $507. Okay, so we essentially have a credit of 507, meaning no matter where Google goes after earnings, even if it crashes, you can see we will make a minimum of $507 on this trade. Okay, and if it goes up, you can see we could continue to make profits. All right, so basically, imagine going to the casino. You get lucky in your first few games of poker and you make $1,000. So this amount of money is essentially the casino's money. In other words, the house's money. And for your next games, you would only bet less than the house's money so that if you did lose it, you would never lose your own money or be at a loss. So that's the secret. You have to trade before earnings. Okay, and then make a profit using our strategies and usual option activity, like what we did for Netflix as well. Okay, we started trading Netflix prior to earnings, early March, took profits, which was at a pretty good time because you could see it made a high just a few days later. And then we used a portion of that profit to trade earnings. We always want to make sure that you use less than the amount of profit you made so far, right? So that is how you can convert your trades for earnings into a risk-free trade with no loss. Okay, you have to make sure to start trading before earnings, and you also want to make sure to use options because options can allow you to define your risk. Okay, that is the advantage over stocks. And so that is what we do. If you want to learn more on how we use option strategies, make sure to go to our website. We'll put a link at the top here. And if you missed our video that we just published on Google, where we made the 200% profit on the last trading day, put a link to that video as well over here. So you can see how we were able to trade Google before earnings and then now using that profit to trade a risk-free earnings. Hope you learned something. Please smash the like button, subscribe if you haven't, and let us know what you think will happen to Google for earnings. Comment below. Take care and have a great day.